In this episode, part 3 of the discussion of property versus stocks, we give you an even better and more value discussion because we actually dive into our personal case studies, and each and every one of us share real life examples of what we've experienced over the last 5 to 10 years in property and stocks. You get a real sense of the returns that we've seen. You get to understand what it's really been like, where there've been ups, where there've been the downs. And what's great about this episode is that on both sides of the fence, every single person on here has actually got a stake in property and in stock. So you get a real well-balanced discussion.
Take off, take flight with you.
Guys, good morning, good afternoon, good evening, depends on where you are around the world. Yes, back for episode 81. It's the final and third leg of the stocks versus property. Looking forward to this one in particular because we talk a little bit about our personal case studies, we share some numbers, and also maybe our personal why. So there's not going to be so much of a battle in this final episode. We're really coming together as a four, and we're going to have a great discussion. So before we get into it, a quick check-in on how everyone's doing, and then we can dive into the episode. Daniel, how you feeling?
I'm feeling good.
Really quick, one word. Perfect. Sure. How you feeling?
Great.
Olu, how you doing?
It's the one word. When you said one word, that kind of threw me a little bit.
Mine is change. And I've got a announcement at the end of this episode for you guys and also for our listeners. So we'll finish the episode.
I know what it is. I know what it is.
I think Daniel knows what it is. Don't say anything.
I was even going to call you.
Don't say anything yet, Daniel. I want to see the other guys' reactions. So we'll talk about it.
I want to get to that right now.
Let's do it.
Okay, cool. So
you want to start with it?
Episode. Thanks for listening to this episode. We hope you're all doing well. And now for Olu's big announcement.
Do we want to start with the announcement? Let's start with the announcement.
No. Do it yet.
Do it yet. You sure?
Yeah.
For everyone that's listening, this is. I mean, I'm hoping that you listen to the end of all of our episodes anyway. But if not, this is the one episode that you want to make sure you stick to the end, because what Olu's going to announce is going to be earth-shattering, mind-blowing.
And in case you're thinking of skipping to the end, we might even just drop it in the middle. Or towards the
end. Big news.
Big announcement alert.
I don't even know if I want to say anything. I feel like what I might say may skew. Anyways,
but P, how are you? How are you, P?
I'm good. I'm feeling the word I have to share is full because we're able to eat now, post Ramadan at any time of the day. So I'm feeling good.
That shirt is bulging.
I'm telling you, I need to go to the gym, man. I've definitely put on a bit of weight, especially in the face. See the cheeks?
Yeah, I saw that video. You and Karen trying to run. I know you're out of breath. You are blowing like Ronaldo.
Good. Let's get started. Perfect. Personal case studies. I just want to share some numbers. I think it's a great way to sort of finalize this discussion. Happy to go first. So I'll share just 3 examples of sort of some property examples, 2 of which are actually under one in my personal name, one in my company. And actually I wanted to share a family asset just to provide some perspective on a longer historical duration and sort of share those sort of numbers. Cool. So just to get into it, and I've shared this already on Instagram, so it's not like if you're hearing this for the first time, sure, go ahead.
Pete, I was just wondering, I can't remember whether you've already explained what we're trying to do in this episode. Have you already done that?
I did.
You mentioned it already, right?
Yeah.
So less arguments, less all that stuff. Okay.
This guy is sleeping, bro. Alright, cool. Never mind. Nandi, keep that part in.
Oh my God.
Good. Kicking off with the first one. This was really quick. I don't think also that we're gonna comment on each other's performance because it might get a bit peak. Or all I'm gonna say, it's just we can just share numbers and we can keep it moving. so on my
offensive.
On my me.
Yeah, you.
No, I'm just saying because anyways, let's go. On my first property, I purchased this one back in 2015. So I secured it at £240,000. and today it's worth around, say, £300,000. That's being quite conservative. So when we spoke about the growth rates on property as an asset class, that actually is a 20% return over the period. But to Olu's point, it's year on year is 4%. So that actually accurately speaks to real estate prices growing around the 4%. Now, the one I wanted to sort of pay attention to and I raised is that's been the price of the asset that's grown, or the growth of the asset. But the equity itself, I invested £36,000. It was 15% down. Residential mortgage meant that I was paying down the debt. And then because I've been paying down the debt over the 6-7 years and the price has been going up, that's now looking at around £121,000 of equity. So that growth in itself is like 70%. So this is kind of why I was sort of providing that perspective on, and that also speaks to the leverage as well. So I think that's quite powerful. Now on the cash flow side of things, Ollie's gonna love to hear this. In the first year, I've got year on year. In the first year, it's 2.5%. In the second year, it's negative. And by the way, this is cash flow based on the money that's left in the deal, right? On the second year, it's negative. So that's a boiler I had to replace. On the third year, 7.3%. Year 4 was 4.5%. Year 5 was 5%. And then year 6 was 8.2%, right? So you can see it fluctuates. And there are some years where it is negative. On the second example I wanted to give was actually the first property under my company. This one was a situation where unlike the first one, I refurbed this property, so I kind of forced the appreciation value, purchased it at £91,000, and then I actually refurbed it. I put about £13,000 in, and that forced the appreciation and got it to £130,000 value. So that in itself, that asset growth price is like a 30% over a 2-year period. So like 15% year on year, but that's obviously speaking to the refurb that I've done. If I talk about the cash flow on that, year 1 negative. I was holding that for a period of time, covering the mortgage. I didn't get tenants until relatively late, and then on the second year, it's done 5.4%. So just some perspectives there. The last example I wanted to give on a property standpoint was actually a family asset, and I just thought this would actually be quite cool to share because it's not been used as an investment, and that obviously that debt's been paid down. So this was purchased in the year 2000 for £121,000, and 20 years on, it's around £450,000. So that also speaks to what we've been mentioning, which is about a 4% year-on-year growth price over the period of time. So just some property case studies and numbers to provide some context on what we've discussed in part 1 and part 2. I've got some stock numbers, but maybe I'll share that on after.
Yeah.
After.
No,
I think firstly, great examples. I like the final example because I think it showed 20 years, right?
20 years.
Same as what we say with stocks, right? Hold for the long run, right? A lot of times when we think about properties and stock, it's the same concept. The longer you hold it and you're consistent, by quality, you hold it for a long period of time, you're going to see crazy. I think in that example, it was what, 3-4 times, 4x, whatever the value was, right?
121 to 450.
Yeah, so fantastic growth in that equity, which is good to see. But it was 20 years was, I think, the key thing I heard when you said that one. Did looking at your properties and your investments and the returns that you're seeing year over year, was there any eye opener as you started looking at the returns you were getting on a year by year basis?
Yeah, the reality is much lower than the projections, and that's just the honest truth from a cash flow perspective. So if you buy and hold, you're going to see the returns on your asset growth. Equity is going to grow relatively well, but where it comes into, and this speaks to systems and looking at ways in which you can really secure that passive income. I'm learning as an early investor that whilst a deal is projected to do maybe 10 to 12% as a single let, maybe in the first year it's done 4%. Right, because you're kind of getting it into its stage where you're getting it firmed up and ready to go. So it starts to perform better as it goes, but you've really got to be patient and wait for those returns.
Cool.
So that's probably my surprise, if you like, being very transparent.
Yeah. Thank you. Appreciate it.
I've got some stock numbers to share, but let's Daniel, you go. Ollie, you on mute.
So, do you want to say your stocks as well? Maybe give some stocks because I've got some. I was going to do property and stocks on mine, so I give a fair balanced view. Sure, what were you going to say? Sorry.
Man, sleeping. Ollie, I think
Daniel, you go.
I think Shaw you wanted to say P's gone for property. Let someone for stocks go next. Then property.
Yeah. Go. Just do that.
Sleeping.
That's exactly what I meant.
Daniel, do you want to go? Daniel, you can go. I
don't mind, but I don't know the format because all I've got is percentage increases.
That's cool.
That's
cool.
fine.
Percentage increases. Keyword increases there.
Go on, Daniel. Go on.
So how I'm gonna share this? I'm gonna go through some of the stocks that I hold and how they've appreciated over time. But then also I have had some losses. I'll be completely transparent. There are some that are in significant red, almost triple figures. Which means I've gone back to zero. I'm not even gonna lie.
It's making me laugh, man. But then I think, Daniel, to that point, mention that it's a portfolio, right? So your best ones offset your losses, and in the end, net, you're up.
Am I?
Go on.
Okay, so I'll start with one that I bought. I think it was in 20.
Daniel, you know you're supposed to be defending why people should invest in stocks.
No. I'm defending. I'm going to be completely real.
Exactly.
I'm not going to try and beat around the bush and trying to say, yeah, my portfolio is up 80%. I've never had anything in the red.
Yeah, we can already, based on Olu's comment, we already know that he's going to be biased. So at least you can be the honest.
No, I'm going to be transparent. When Daniel talks about the ones that have gone negative, he needs to talk about the strategy in which he was investing, because there's speculative investing, and that's what I'm talking about. It's just like in property, right? The ones that Pabilo explained, they were traditional quality properties in which you're buying. Daniel does quite a bit of speculative investing, right? And everyone knows we're speculative into investing. You messaged me a few times.
Continue.
But in terms of speculative investing, you're gonna win some and you're gonna lose some, right? And the biggest advice I have for the listeners, if you are doing speculative, right, protect your principal. So even when Daniel's talking about percentages and what he's lost, it would be good to understand what amount he put in there. Because for our listeners, if you are going to invest and go down that speculative element, don't take out all your money in your savings and put it into some of the ideas that Daniel's done, because you can.
This is not financial advice from Ollie, by the way.
Yeah,
he's not wearing his turtleneck, so don't listen to him. I'll talk about my most top performing stock at the moment, and that's one called ᴠɪᴇᴡs. I bought that, I think, in good 6 years ago. That has given me a good return of 182.91%. So 182.91% is the return on that. The next one I've got that's done quite well is Twitter, which I bought just after IPO, and that's at 113.93%. I've got one that I bought earlier this year. I think it was February. That's given me a return so far of 112.79. One that has been quite up and down and fluctuating is Boohoo, because of recent news. I think last year April was about workers in Leicester and whatnot. But so that's been fluctuating. But at the moment, that's up 40%. I've got others that are in the green that are really good.
So those first three are doing like about 16 to 20% year on year, isn't it?
I'm not gonna lie. I haven't tracked it. I haven't tracked it year on year. So I don't know what the year on year returns are. But maybe net could have been. So Twitter was IPO, I think 2014, 2015. So I've held it since then. ᴠɪᴇᴡs as well. ᴠɪᴇᴡs was actually it was underperforming for quite a period of time. And in the last 18 months, I'd say it's picked up quite significantly. But in the last 4, even more so. I actually put one on International Airlines Group, the one that owns BA Iberia, early this year. I think it was January, as we went into the 3rd lockdown, I believe it was, in the UK. And I thought, actually, I was reading some airline news and watching the airline industry quite closely. So I thought, let me put something on IAG. I thought that given, I think it was Boeing 747s, there were some aircrafts that were going into production, or they wanted to increase the fleet. So I thought, okay, I think that the airline industry, as we look forward and coming out of lockdown globally, hopefully this year, that flight and holiday and leisure would increase, and therefore the airline would pick up. Shortly after I bought it, it dropped.
Did you buy more?
It dropped, but I didn't buy more actually. But now it's actually plus 25%. So it's increasing over time, slowly and steady. And of course, with my strategy, I'm looking to hold for the longer term rather than the short term. So even with the example of Computer Center, where it's given me 182% return, I'm not taking out any of my holdings in it. I'm keeping it in there. And if it fluctuates, it goes down, it's fine, but I'm keeping it in there for the long term. When I look at skipping down to ones that haven't performed so well, there was one Capita, and this one hurt. This one really hurt. This one is at minus 93.87.
Jeez.
Minus 93.87. And there was a time when I should have sold, I think it was 2017. It's just, it just tumbled. I think there was something that's...
Daniel, you might need to go back and say that again, because you were breaking up a little bit. Yeah.
Yeah, sorry. Yeah, I was getting a phone call. Sorry. So there was one sorry, it's down 93.87%, and this one hurt. I should have sold it quite a few years ago, but because I didn't and it tumbled, I thought, you know what, I'm just gonna leave it in there. This one is really messing up my complete net figure because I'm just holding it. I'm not selling it. It's just ridiculous.
So Daniel, let me ask a question. In that scenario where you're down so significant, you're down so much, what do you do? Like, you're just looking at a minus number and like I don't really think of that scenario, right? So do you leave it, crystallize it? What do you do?
So you can leave, well, if it wasn't so negative, you can leave it in that hopes that over a few years it would just kind of bounce and rebound, which I've seen a lot of people that I follow. They've waited about 4 years for their stock to go from the red to actually making a profit, because just external factors or things that have happened to the company, and it's just made the share price tumble. For me, I'm so far gone in this and just so annoyed that if I take out what's there, there's no point. I'm just gonna there's no point. I've got no use for it, so I'm just gonna leave it there. And if it continues to go to zero, I'll let it drive itself to the ground. I'll be happier for it to go to zero than me take out what's there. Put it that way.
What other losses you got?
I've got other losses. There's one petroleum, a Nigerian company listed on the London Stock Exchange. I think I bought that when they went IPO. They did a dual listing, so on the London Stock Exchange and also the Nigerian Stock Exchange. And that one's just been draining me since, a bit like oil, it's just been draining. I bought that more of a speculative, thinking that over time it would increase, because it was the time where the likes of Glencore were doing well, oil prices were going up, crude oil. I thought it'd also trickle into this particular stock. So as it happens, it hasn't. But I will speak on two notable stocks that I've sold. I think I've only ever sold 2 stocks actually. One was Sky in 2016 January, and the other one was Glencore. I sold Sky because my initial investment, I think it went up over 100%. I think they were being taken over, and the share price just rocketed. Then I cashed all out, took my profit, enjoyed my profit, ate the fruit of my labor, and we enjoyed it. And then Glencore I sold, I think this year actually, because it was another one where it linked to the industry and it just wasn't really performing well, nor was the industry. So I thought, okay, let me sell this and then reinvest into some other stocks, which I've done. So in my holding at the moment, I've got 15 stocks that I hold in my trading account, and I've got a few in my ISA account that I'm holding. The ones in my ISA aren't doing particularly well at the moment, but I have confidence in them, hence I bought them, that they will overturn and pick up. Unfortunately, I can't tell you my net figure for the portfolio because I haven't calculated it. I don't put these or track them in an Excel spreadsheet, so it's just all online. But what I will say, I have a renewed strategy. So my new renewed strategy going forward
All in property.
No. Actually, earlier this year I invested in a course. With someone who's had about 12 years worth of experience in a number of asset classes and markets. Previous Goldman Sachs trader, Barclays, and so on and so forth. I enrolled on this course. Not that I needed a lot of the information, but I wanted to hear from someone who'd done it professionally and is doing this full time. So part of his course, you enroll into community. You learn as a group. It was 5 weeks on a Saturday, every Saturday for about an hour and a half. And you're learning, he's teaching you a strategy that's worked well for him, that he deployed in his work and he's doing it in his private life. And this strategy aims to help you grow 20% year on year. And you may say that's a bit ambitious, but his strategy is proven to be successful. It's not complicated. It tracks a number of over 800 different stocks. You pick the stocks you want. It has a target buy price and a target sell price, and you follow that strategy. You can also average down. So if you have, for example, say £1,000 allocated to a particular stock, you don't put all 1,000 in one go. So you average it out. So you might put it 400. And as we've seen in the last few weeks, the stock market has been on sale. So this would be an opportunity to buy more. So your net price that you buy is actually lower than if it fluctuates. So this is a strategy that I'm actually starting to deploy. So that if you were to invest from the start, he suggests 5,000 to start with. You can obviously do 10,000, 15,000, 20,000, whatever figure you want. He starts with 5,000. That in 25 years' time, compounded over 20% year on year with taking no returns, not adding anything extra, would get you 468,000 or so. When you play with the figures in a compound calculator, even adding an extra £50 a month can increase that substantially. So there are some small figures that you can add, even to a 5,000 initial from a principal, to get to over 2 million. So it's something I'm looking at more closely. I don't have to do the work myself. People are picking stocks, and there we go.
So it sounds like you're selling a course, big man. But now I understand why you're so confident at achieving 20% year on year. So makes sense.
Yeah.
Good. The one thing I will say, Daniel, is that people listening to this are probably going to want to know your dividend yield on those growth stocks. So all I'm saying is when they reach out to you in the comments, just make sure that you share your dividend yield.
I'll be real. I don't take dividends. I just I do automatically reinvest. I don't take.
How much dividends on average was on offer with the stocks? Like, are they all yielding dividends?
He doesn't even know. He's not even checking.
I get an alert to say that dividend, but I don't even check it. I just reinvest it straight.
Olu.
Sure. Cool. Should I go and then you could go, sure?
Yes,
yeah,
please.
go ahead.
So my strategy has been, I'm going to give a few examples on some of the investments that I've done, some that have worked, what my lessons learned, because I think with any sort of investment, property or stock, you should always learn from whatever the result, if it's going well or if it's not. So the first sort of investment that I've done was company shares. So first one I have is GE. So I joined GE in 2012, 2013. And what our company provides is an opportunity to buy company stocks at a discounted rate. So you get 15% discount. Already looking at that, you've made 15% profit because you can actually sell it as soon as it's hit your broker. Obviously, you have to pay tax on the profit, but you've got a guaranteed 15%. Now, my strategy with that was I look at this as more of a long-term investment. So I wasn't looking to sell it quickly. So I've been purchasing, let's say, approximately around £500 every month. And then it starts increasing as my salary increases. So now this, I'm just going to throw round numbers, not actual numbers, but approximately around 30K is what it got up to, right? Of just pulling it there. Now, if anyone knows about GE General Electric, right? 2-3 years ago, the company stock prices got hammered, crushed, right? some cases came out around the accounting, to a point that 30K, right, dropped to around 15K, right? So now it's dropped significantly. Now, at that particular moment, I've now got a choice, which a lot of people have with their investment, right? You can either take it out, take the loss, but obviously when you take the loss, you can offset that with any gains. So there's tax efficiency by taking losses. But instead, I decided to keep this because they just they had a new CEO who, based on his track record, previous companies he had worked for, had shown results in terms of his previous companies. So now, by keeping that particular stock portfolio, in the last year, that portfolio from that 15K, 2015K has increased another 15K. So I'm looking at, just by the terminology of what I've been telling, buy quality businesses that have good cash flow, and then hold for a significant amount of time. We've seen the market correct itself to a point now that I'm probably at 9-10% loss on the whole investment, right? So that is a situation that if I had panicked, taking it out when I saw the red, right, I could have easily have lost 50% of my portfolio. And this is not paper money, right? The moment I sell, you actually recognize that loss. So that's the first example. Second example, which I like to mention, is around a company that I've been investing now for the last year, so probably around a year. Again, same logic, 15% discount. This time I did a lot more research in terms of understanding, okay, this particular company, what does the market predict the fair value for this to be? Now, this stock was at like $20. It dropped significantly to around $8, right? But when you look at it drop at $8, you need to now look back and understand, am I purchasing this property at a discount? Because if you believe the fundamentals of the property, stock, when that stock drops in value, you should look at it and say, I'm purchasing this at a discount. So I kept my amount. It was approximately around 1K each month, just investing. Now, just in a year with this particular portfolio, looking at the numbers, it has returned 30% profit. So 30% profit that this particular one has actually returned. Now, the last example that I want to talk about is more on my growth strategy. And I want to make this even more real because P likes to mention paper money, right? You're just seeing numbers down.
Olu, just to re-emphasize, we framed this session as not a battle, but a conversation.
No, I'm reminding the listeners, if you haven't listened to the other two episodes, go back, listen. But just to bring it...
listen, we all... we all have paper wealth. We all do.
Okay.
We're just basically saying what hits the account is then real cash,
exactly.
right? That's it. So
I'm going to give a real example. So I'm just, again, you're going to give rough numbers. So invested around 5K 2 years ago in the stock market, focusing on quality businesses. So household names, Amazon, Apple, Facebook, Netflix, companies which I know in 5-10 years time, they're still going to be around. And again, I'm looking at their cash flow is really what I'm focusing more on. Now, beginning of this year, I filled in my tax returns for my properties and other stuff. And the tax man said, oh, you've been underpaying your taxes, right? You need to give us 7K. Yep, 7K. So now I've obviously got properties. I can't go to the bank, and I can technically go to the bank and leverage that property, but it's going to be a long process, right? It's going to be a long process for the people on the property. So what I did was I called up my broker.
Before you continue, why is the taxman correcting you? His numbers should be clean. Anyways, continue.
No. It should be clean, but you know when you get certain...
I don't know. No, I don't know.
Lump sums. You receive certain lump sums. It just throws off the calculation. Lump sum just throw off the calculation.
Keep clean. Go on. Okay.
If any taxman is listening, I pay my taxes. So I looked at my stock portfolio, right? And this particular portfolio, growth stocks, had grown 70% over the last 2 years. So what I do, call up the broker, say I want to sell, the funds hit my account in 3 days. Taxes on it, because you get a capital gain allowance of 12K. I didn't have to pay any taxes on taking out that gain on profit on those stocks. And then I was able to pay the tax man. The residual amounts I decided to invest in other portfolios. So those are like 3 examples of some of the performances on my stock portfolios. I've got so many others that I can discuss, but
Olu,
for the
now that
time,
I know you had to press the button to take some profits off the table to cover a tax bill, I have lost all credibility for you and your case.
as much as you want to say you lost credibility, what I'm trying to mention in this, what I want to mention in this is just the same way that you said. And let's be honest, in life, accidents occur. It could be a boiler, it could be medical, it could be the taxman, right?
It could be a boiler. Definitely could be a boiler.
I would have preferred for it to be a boiler. The taxman, man. I would have preferred for it to be in a boiler. I'm just saying. I'm playing. But what I'm saying is,
remember when you pay taxes. When you pay taxes, it's based on the income you've made. So you need to make large amounts for them to tax you.
For them to correct
they don't tax zero or negative. They tax profits.
They only get it wrong with small boys. With big boys, they don't get it wrong. It's squeaky clean. I'm telling you. I'm telling you.
Wesley Snipes. Wasn't he in prison? Big boys.
Who said he's a big boy though? Well, you did.
Okay.
He didn't make any money from New Jack City. Go on.
But what Olu's trying to say? Is you're able to easily liquidate your stocks, especially if it's within that tax-free allowance, so you don't have to pay your capital gains tax, your CGT. But
flexibility.
Wake up, Shuel. Wake up. Over to you.
Yeah, I am back at the wheel, but this time I am awake. So thank you guys for the great examples. I think to try and add another dimension to what Babila has already said, I think I'll give an example of a particular deal and look at it in terms of the return on the cash that I have left in, so the money that I have left into the deal. So as an example, so there was a property in the Hampshire area that I'm investing in. There's one particular property which cost 137K. So this was a property that was in pretty terrible shape. 2-bedroom, terraced home, completely trashed, if I'm honest, and needed a bit of work, but it just looked a lot worse than the actual work needed. Just on the surface, it looked quite bad. Got that property for 137K. It required some refurbishment, etc. Refurbishment was around 12K. Now, upon revaluation of this property, it got revalued at 190,000. And then what that allowed me to do was basically to refinance out the money that I had put in. So at the end,
sorry to cut you off. This sounds a bit like similar to my strategy, which I shared in the part 3, the BRR.
Rise.
But sorry, carry on.
Rise.
Yeah,
rise.
By the way, if you guys haven't checked that out, it's one of many strategies that we spoke about in actually part 2 episode of this discussion. So do make sure to check that out in case you've missed it. Now, on that note that Daniel was saying about buy, rise. So I bought it at 137, did my renovation, so that's the other R, and then it was a refinance, and that basically got refinanced out at 190,000. So then basically with that asset, I went to the bank and I said to them, look, I have a real estate asset, not a stock, not an option, but actual a real hard asset that I can demonstrate to you at the bank. They refinanced this and revalued it at 190K. So what does that mean? That meant at the end of this particular project, I had £10,500 of my money still left. So this is the money that I've put in at the beginning to buy it at the 137 mark, minus the money that I've been able to recycle out after the revaluation. So I've essentially got this £190,000 asset, but only had to put in £10,500 to get that. Now, on top of that, there's that.
Sorry. It's just I love the way you worded that. Sorry, continue.
So on top of that, there's the added benefit, and this is a benefit that Babila and I have really spoken about a lot, which is the cash flow. So this particular property, it's generating a monthly rental figure per month of £800. Now, of course, there's other deductibles I need to take out. I need to pay back the mortgage. There's also voids, etc., that I need to account for. So basically, with this property, once I've taken out the other fees, I have roughly about £400 left per month net cash flow. That annualized is around 5 to 5.5K. Now, just dividing that over the 10,000 I had left in the property means that that's a return of 50%. Once going through that overall process of the money that I have left in versus the money that is being generated from that property. So that essentially means after 2 years, I still have the asset in my books. I've got all my money back out, which I can recycle for the next investment. And then on top of that, I've got this asset that's continuing to generate the cash flow. And as well, I still have my 25% equity tied into the asset, which will appreciate over time if it's a good quality product in a good area and there's good demand, etc. as well. So that was the one example that I wanted to give on a specific project. And then just on an overall basis, with the properties I have at the moment, so at the moment I have 8 properties in the portfolio. Since 2017, in terms of the money that I've had to put in or from investors, it's been in the ballpark around 300K. So that's how much of my own money that I put in. But then with the uplift that I've received from appreciation, from the buying a good value price at the beginning up front, so doing good negotiations or dealing with people who are looking for a quick sale, I've been able to double that equity that I basically put in. So of that 300K, we're about 600 in
Solid numbers.
Oh my God. So that's basically where I'm at now. Of course, there are months where the cash flow has been lower. There's been months where I've had not months actually, there's been one property where I had a tenant who wasn't paying me the rent for 6 months. And I had to go through the process of getting them evicted, of course, in the proper manner. There's all these factors in play, so it's not all blue skies. There are challenges, but just directionally, I hope that that helps.
No, sure. I think those numbers they're solid, and I think you see with what you've mentioned, you see the power of having multiple properties, right, in the portfolio. Question: the first one that you mentioned, are those projected numbers, or like Pabilo? Can you give like actuals, like roughly? Have you been seeing that 400 or that profit from day one, or is this projected?
So this is the 400 on a month is pretty much the average return that I've received on that one. This is actually a deal that I did in 2018 or 19 now, so it's been a couple of years. Okay. And that one's been pretty stable actually.
Nice. Okay, cool. Fantastic. P.
I like Olu's face. When she said 800, me and Olu had the same. Because at first I thought
you know what my question was going to be.
At first I thought Schwar meant net, and I was like, what? And then Olu was thinking, what's going on? Good.
P, do you want to give some? Because we still got some. Do you want to give some of your stock example? Because I've got property experience.
Yeah. So
I want to always give.
I think I want to just jump on Olu's point around company stocks. I've taken advantage of company stock. They usually have programs which allow you to buy at a discount, or they allow you to do a matching program whereby for every pound or Swiss franc that you buy, they'll give you 2 or 1.5, something along that. So I was just actually looking at my company stock and looking at the growth on the stock price itself. So over a 7-year period, I've seen 12% growth. And some years it's been higher, some years it's been lower. So I've just kind of averaged it out as to what it's been from the start until now. The dividend yield on that has been 1.8%. So it's been, super passive, right? I don't even think about it. I forget I have it until I receive a dividend. I would just obviously love for that dividend yield to be a lot higher. That's all.
When you mentioned the 12% or the 12% that you mentioned, does that also take into consideration the benefits that you get?
No.
So that's just
15%. So that's actually, to be honest with you, that's actually like difficult to calculate. So the benefits make it, there's no point even calculating the return on investment because it's super high. Like what it basically means, if you're getting a matching program, you can afford to lose so much and still be basically okay. So it covers
your risk.
It covers your risk.
If you're buying the stock at 15% discount, like we were doing, if the stock still was to reduce by 15%, I'm still break even, right?
Yeah.
Because of that element. Yeah.
But what I will say to that, the flip side or the catch to that is, in order for you to benefit from what they've matched, you have to stay at the company for a certain number of years, right? So it's a vested period. So there's a little bit of exactly, yeah. So it's tied in for a certain number of years. On the second one, I still have this stock. You guys sold it shortly after IPO, but I still have the Royal Mail stock.
I still have that as well.
I still got mine.
Oh, okay. You guys sold it.
And the returns is increasing.
It went from red to green. It went from red to green.
It went to green.
I'm like 27% over 8-year period, 3.5% on the dividend yield, but obviously it's a very small amount. But again, it's there.
£750.
I don't think about it. So that's what, a little bit of 1,000, just over 1,000 now. So that's there. The other one actually I've got is a spin-off from the company that I'm working for, which is I've got some Alcon stock. So that's an eye care, the leading eye care company on sort of cataract surgeries and things of that nature. That's actually down over a 2-year period, 17% down, 0% dividend yield. It doesn't pay a dividend. But again, I will hold it. I don't plan on selling. And I just have this notion that everything will turn and eventually once be a lot more than what I first started off with. So yeah, that's just a little bit on the stock. From a cryptocurrency standpoint, that's booming, baby.
We're going into crypto.
That's not.
Oh,
look how that you came in. The cryptocurrency is booming. So I mean, I got in. I just say when I got in in 2017. Got some of the coins. And yeah, and I've held on ever since. Even when they went down to like a super low numbers, right?
You took most of the supply.
No, I didn't. Like 100, 200, right? Even when they were low, and I actually like writ off cryptocurrency. It basically proved me wrong. So the other thing I actually wanted, I'm not gonna basically speak on it, but I would at some point try and find a way to share that experience. Is I held a mutual fund for about 6 years, and that would be good to share. Because in some years it was doing 29.5%, 13%, and then the last year was minus 0.8%. So I will share that story and the lessons behind.
You should give us what that's analyzed. If you go up 30% 1 year and negative 1 year is still good.
But I think actually when I speak to the whys, I think that goes against my why in terms of why I look at investments now. So yeah, that's just a bit of stock portfolio. Cryptocurrencies is booming. Daniel's itching to go. So yeah, we've got a couple more minutes left. Anyone want to share a bit more?
Let me share just a property examples.
Yes.
So I've purchased a couple of properties. I guess one question I have for you two is: have any of you sold your properties yet, or any of your properties?
Never.
Okay.
I'm going through one sale now.
Yeah, I'm literally in the process of completing my will, and in the will, nothing will ever be sold. Ever.
The funny thing on that point, it's funny because my great granddad, his properties in Nigeria, he said that none of them could be sold for 100 years. Nice. So a lot of the even as they're like being looked at now. There's part of Lagos where he's got quite a few properties, etc. But in the will, none of them can be. It's stated in his will that the properties can't be sold for at least 100 years.
How many years have gone by so far, Daniel? Do you know?
Boy, I think. What year are we in now?
2021.
2021.
It's coming up to, I think it's in the next couple of years it'll be 100 years, put it that way. I don't know exactly when, but shortly. Yeah.
Damn.
They need to extend that, man. They need to bottle another 100 years.
Yes, that means 2025. We're all going to Bali, and it's on Daniel's head.
Olu, you want to share?
So just a quick one. So I purchased a property in 2016, right? Now with this, I'm just going to use rough numbers. It was approximately around 300K. Which meant in terms of the amount that I needed to pay and hold up in that property, you're looking around 70K is sort of 25%. 70K is roughly what you need to have to put against that property. Now, after sort of looking into that property and saying, okay, am I seeing the capital appreciation X, Y, and Z? I realized that no, it's not. So this is a good opportunity for me to sell out and look to move that 70K somewhere else, where it's generating, because money is just opportunity cost. Now, and the reason why I said to you guys selling properties, right? I purchased this property 5 years ago. Now, if I look at Zoopla, if I speak to my bank, right, they'll tell me that the property is going up, right? It's around 10% gone.
Do you want to share why that property hasn't grown? It's a type.
I'll share that end. I'll share that end.
Okay.
Because I like to share the lessons learned with all my investments. And so they tell me it's gone up by 10%, right? Now, I said, okay, let me put it on the market, got a valuation, got someone to come down, started looking at what properties around the area had sold. And I'm looking at potentially it's going to be, let's say, 20K less than what I actually purchased it for. Like after fees and everything, 20K less. Now, when it comes to selling, that 20K is real loss because it's not coming out of the bank's element or my mortgage. I've got to pay them whatever I borrowed. So that 20K will technically come off that 70K that I put down, and that would be real loss if I do decide to sell at that particular time. I'm waiting for the market to change. Now, lesson learned for me personally was not to invest in apartments because it was in apartments. They're good for cash flow in terms of Airbnb elements. But in regards to resale, they're not the best. Also, there's costs that you cannot control, such as service charge, which you can't control. And if I look at this particular apartment, it's been going up like 5-10% year over year. So it's now becoming even more expensive and taken away from my profit. So I think that's an element where I was like, okay, yes, the paper, Zoopla, all of that says it's got good equity. But the reality of it is when it's now time for me to sell, that's going to be a potential loss that I'm going to have to eat. So that's why I want to share that. Perfect.
Oh, great.
Anyone else? I'm going to go and get the announcement for you guys.
Yeah, I think
finish.
Please share the announcement or do you?
Yeah, let me share the announcement and then you can do the wrap up. Cool.
Sure.
1 sec.
What is this guy going to get, man?
Do you not know?
No, but he needs to
think about what he's.
Is it you guys ready for the announcement?
It's a dog.
Billy!
Oh my days! Let me see. The
new member of the Take Flight podcast. Hey, Bo.
Oh, don't kiss it. I'm only about to lift.
So this is Bo. This is Bo. Say hello. You want to say hello to them?
Oh my God!
How old is he?
How many years old?
He's still sleeping, bro.
Oh my days! Fam, yeah, she was definitely sleeping. His reaction was like 10 minutes late.
No, do you know why? It's because I had another window open. That's why
okay.
I could hear, but I couldn't click out.
So he's 9 weeks old.
Yeah,
9 weeks old.
Yeah.
So Olu, are you the sole parent?
No, I'm not. But I'm the proud. Oops, careful. Okay. I'm the proud parent of Bo.
He's a dog dad.
His name is Bo, which two things, right? Bo, French for beautiful, and it's also Nigerian for Babatunde Okunola.
Okay.
I've always wanted a Nigerian dog, so this is Babatunde Okunola. You guys could call him Bo. Ain't that right? Okay.
Where does he sleep?
You guys can call him Bo.
He sleeps in his crate. Crate trained.
Olu, trust.
I'll be back in 2 seconds.
This is a completely different side of Olu that I've never seen before.
Different side.
Yeah, I've never seen.
Olu, just put Bo on the floor, man. Let him walk out. Let him run out.
He's not allowed in this office.
Olu.
It's not pet proof.
Olu, you're right.
Okay. I'll be back, guys. I'll be back.
Oh my God. I have never, ever seen that side of Olu before. The way that he's stroking and holding that dog and talking to him.
But he looks scared though.
Oh my God.
You know, one thing I will say real quick before I close this episode, people have looked at during this pandemic period is getting pets to, I don't know, to maybe. Wow.
You know how much it's spiked? It's great. I looked at some figures. It's gone up like over 200%.
Wow.
Like
200, so that was the announcement.
Is the money Olu back? Because the other version of Olu was I don't know, the caring, loving. I've never seen Olu before. I probably won't see it again. Probably it came and went. What's the dividend yield on Bo?
Happiness.
Speak on it. Speak on it.
Joy, you know, I can't always be on this financial journey and this 24/7.
Clearly, I
You
can
know,
see.
sometimes I've got to slow down and enjoy life a little. So
What you want to do? What you want to do is just get yourself a baby. That's what you want to do. That's what you want to do.
Baby steps. Start with
that's what you want to do.
and then we move forward.
Good, perfect.
Cool,
guys. It's been a great episode. I clearly underestimated how well we were going to do this. So we're actually going to have to. We're going to have to create a part 4. And we're going to make it relatively short so we don't drag this out any further. But I think it's really good now that we've had the first episode was around, you know, points from either side. Second episode was sort of advanced strategies. Third episode today, which has given some personal case studies and examples, which I think has been fantastic to provide better context to what we've been talking about in the last 2 episodes. And I think in the final episode, I think that's going to be even as important because it's our qualitative, personal experiences and our real why as to why we are property or stocks. And I think there are going to be some stories in that episode which are going to be quite powerful and really help to sort of crystallize this entire discussion. So yeah, it's been great. Episode 81. And we look forward to discussing with you guys on part 4.
So if you have any feedback for us, find us on Instagram at Take Flight Podcast. Stay well, stay safe. God bless.
Take off, take flight with you. We never fly, but